So, Tanya, then with rates starting to come down, like in the past, when you've got a cycle where rates are coming down, there are people who will break their mortgages to get into lower rates, and they'll pay a penalty to do that. But when you do the math, in some cases, it makes sense to do that. And those penalties can be substantial, but so can the savings.
Right.
Have the rates come down enough for that to start happening? Are you seeing some of that? Are you seeing any of those conversations? And my follow-on question there is if somebody's being forced into renewing their mortgage now, is there anything they can do to be prepared to potentially take advantage of that if rates continue to drop?
Yeah, so this is the same thing we'll probably see like we did during the pandemic when all the rates were coming down and everybody was breaking their mortgage and refinancing. So I am seeing that. Inquiries are ready. And just coincidentally enough, I had a deal closed today for that exact same reason. They were actually with an alternative bank. They qualified for an A lender. I had switched them over and they saved about 2.5%.
Hi, welcome to another episode of How Canada Works. I'm Trevor Miller. With me as always, Adrian Blake. Adrian, how are you doing today?
As always, Trevor, I'm doing very well. I'm looking forward to today's conversation. I think it's going to be an interesting one. How are you doing?
I'm doing well. And you know, what great timing it is to have Tania on here. Just with so much going on in the mortgage world and with interest rates and the Fed finally moving on their interest rate hold that they'd had for 6 months, 10 months. It feels like it's been a long time after increasing it for quite a while. Brought it down 50 basis points. Bank Canada was kind of leading the way on that. And then we had some major changes with just mortgage rules in Canada. So I can't wait to rapid fire these questions, Tania, pick her brain and just see what's happening in the industry, shed some light on what this all looks like and see what she thinks is going to happen going forward.
Well, I know she can handle it. So let's get right into the conversation.
Awesome. Welcome. I'm so happy to have you here.
Thank you. Happy to be here.
It's been not that long, but we chat quite often, so it's nice to see. I think the last few have just been on phone calls, so good seeing you again.
Yeah, absolutely.
Likewise.
Yeah. So busy few weeks. Lots happening.
Yes, it has. In the last this week actually picked up the most. There was just like maybe a week lag from when they dropped the rates to activity started picking up. So this week by far, for me anyways, was really busy. A lot of purchases.
Okay. So you're starting to see that side heating up a little bit more as well. People are getting a little more confident to go out and put some money down on houses.
Yes. And not only that, there was big changes in the mortgage industry with the rules. So the insured, are we just going to dive right into this?
Yeah.
We're in it. Yeah.
Okay. So basically, so there was a few rules that came into effect Monday. We just see here. So previously, the insured purchases were limited to a maximum of $1 million, and that was increased to 1.5 now.
So what does that mean? I saw that come through, but like, what does that like actually entail?
Okay, so before, in order for an insured mortgage, so anybody who wants to make a purchase for an owner-occupied home with less than 20%, they're capped at $1 million purchase price. And that restricted a lot of properties. It consisted mainly of condos, maybe some townhouses, if you're lucky, depending on the area where you live. My area here, townhouses are in excess of $1 million. So really it was restricted to condos. And maybe in smaller markets, you can get into like a townhouse or a semi, maybe very rare, like a detached, depending on the market, maybe a smaller market, yes, but definitely not in the Toronto market, in the bigger markets. So now with that ceiling raised to 1.5, it opens it up to a lot more properties.
Right. So, and I look at this with, a lot of different aspects and the GTA, when you're looking at average house prices, over $1 million in most places, not just Toronto proper, but, out in Burlington, I'm not sure what Hamilton's at right now, but it's got to be, $1 mil-ish as well. And so like you're now extending this area where that just didn't make sense anymore. You go up to my hometown, Sudbury. Yeah. I mean, you can still get a beautiful home for $800,000. But there's certain pockets like the GTA, like Vancouver, Calgary, some of these more major markets where it should be moving up with the cost of the average homes as well. So I think this might make it a little bit easier for some people to get into just a regular home.
Yes, definitely. And everybody wants to be where the jobs are. So the jobs are, Toronto, the GTA. And now that COVID is behind us, a lot of people are moving back into the city, whereas they had moved out because they can work from home. But now we're seeing the opposite. So it's definitely welcoming that they've increased that limit to 1.5.
And correct me if I'm wrong, but there's kind of two outcomes here. It means people can put less of a down payment down, and then it also potentially means they'll qualify for a lower rate, because I think in some cases an insured mortgage might have a lower rate. Am I right on those two?
Yes, insured mortgages typically have a lower rate, and it is, people wonder why, if you're putting less than 20%, do the insurance mortgage carry a lower rate when it's higher risk? But it really isn't higher risk. It's lower risk for the bank, because if you default, the insurers cover it. So it's less of a loss. It's no loss to the bank. And that's why they're able to reduce the rate. However, insured mortgages come with a premium, an insured premium that they have to pay. So it kind of offsets each other at the end of the day. Whereas a conventional mortgage, rates are higher, but there are no insurance premiums with it.
Right. So you might have a lower down payment and a lower rate. And longer amortization, I think, is available too.
That's another
but then,
that I can
right?
back to on Monday. Yes. So basically, this one's a little bit not so straightforward. First-time home buyers. So all first-time home buyers are now allowed to increase their amortization from 25 years to 30 years, which in effect allows for a smaller monthly payment. Okay, so which allows you to qualify for more. All buyers are allowed with 20% down, with less than 20% down, are allowed 30-year amortization only on new builds.
Okay. Oh, interesting.
So they're working actually to allow that 30-year amortization across all purchases, not just new builds.
And with the rates going up, and I know, and we can dive into this as well here, but the banks, I think, and the lenders have been getting a little bit creative in with the amortization that they've been doing on renewals over the last little while. Is this right? Have they been extending it a bit?
Extending it? Okay, so I had a situation, I guess maybe all lenders could be different. I have a situation where I have a client that's on the alternate side. So not with an A lender, but let's say a B lender. And he was trying to get his payments down. His rate did increase since his last renewal. So we asked if they can extend the amortization back to the original amortization on his contract, and they would not. They said that they would have to, he would have to refinance for that. So in that case, it didn't work out. I guess maybe A banks will allow to do that. I don't see many requests for that, but I think at one point they were trying to assist with the higher interest rates in that case. But I think every lender is different.
The reason I was asking this is, it's great for first-time home buyers, and typically you get a younger first-time home buyer as opposed to somebody in their 40s, 50s, and 60s. They're not typically the ones that are making that first-time purchase. So they typically will have a longer runway. But for a lot of people who are moving right now, going from a 1 or sub 2% interest rate to 4 or 5. I'm not even sure what they're going at right now with some of these changes, but significantly increased. You would almost want to extend that out if it is a little bit tight, even later on in life. But that doesn't seem like that's the case right now.
Right, and you can't do that. You would just have to refinance. For some lenders, I can't speak for all lenders, but in this case, he would need to refinance, which means requalifying again and at the stress test. Another change that came into effect actually is if you have a current mortgage that is insured, so if you have an insured mortgage, you can switch lenders to another insured lender, another insured mortgage, without having to requalify on the stress test.
Okay.
So that
interesting. Okay.
that allows for increased competition, and it's better. So it's just better all around for the homeowners. It gives more options, and it allows the current lender to really tighten their pencil when they offer renewal rates.
Yeah, it forces the existing lender to come to the table with a reasonable rate and
That's
not
right.
arbitrarily offer something that isn't out there in the market just because they know the client is stuck to them.
That's right. And we did see that. We did see that. Yeah. So that also helps.
That's really good. That's excellent. That helps a lot. Right. Yeah. Are you finding with rates coming down the way they are you finding that like this is affecting a lot of first-time home buyers the most? Are you finding a lot of people now willing to move up that they to create space for those first-time home buyers? Is there a pocket of the market that is feeling this the most?
So I did have a couple of first-time home buyers come to the table this week. One of them actually was in their 50s. So
okay, cool.
Yeah, you don't often see that. Usually it's like the millennials, the younger age. But I think just all buyers, whether you're first-time home buyers or not, are jumping in. It's been over 2 years of pent-up demand. So I think now everybody's trying to beat the clock, so to speak. But what I did find, what I did notice this week of the purchasers that did come to the table, they were all business for self. They were all business owners. So I feel these are the ones that are jumping in the market first. And a lot of other home buyers, maybe first-time home buyers that may be, employed on a salary, I think they're a little bit more reserved, and they're actually waiting for the rates to drop before they make their move. So I find the common characteristics of self-employed people are they are risk takers and they see the opportunity and they'll jump at it first.
Yeah.
Do you find it's the same thing with investors looking for a rental property? Has that been stalled by higher rates, and is that changing as well, or is this just buyers?
Yeah, so that has also stalled. During the pandemic, you were able to buy, because the interest rates were so low, there were a lot of people buying investment properties with just 20% down. And it would cash flow. In today's environment with higher rates, you would need a larger down payment, maybe 35, 40, 50% in order for it to cash flow. So a lot of investors are not putting that money in there. They're holding back. I did have this past week as well. Last week, actually, self-employed individual actually bought a rental property. It was a great opportunity. We do see a lot of distressed sellers right now, so there's a lot of inventory out there. So they seized the opportunity. They did put a minimum 20% down. It was not cash flowing. They went on variable rates with the hopes that the rates will drop and eventually it will cash flow. So we are definitely seeing a lot more people jumping on the variable rates as well, whereas that was on hold for a little bit. But now that we're on an interest rate decline, we're seeing a lot more of that as well.
Yeah, and it sounds like there's going to be a few more reductions coming over the next little while. I wonder if the business owners moving towards it first has more to do with risk or has more to do with the issues around just affordability. You're talking about a lot of distressed sellers right now. I think a lot of Canadians are really struggling. So I wonder if just that person that has the 9-to-5 either just doesn't have that feeling of job certainty or, that side, or if it is risk. I know we've talked about the business owners being kind of the first ones in on a lot of these things as well previously. I'm not sure you have the answer, but it's it's kind of interesting to me where that's going.
Just from my experience, what I'm experiencing, yes, again, they are the risk takers. So they are the first ones jumping in this opportunity in this environment as well. And they're not so concerned of getting, laid off or losing their job. And that's another factor as well, is the people that are employed are concerned about that because the job numbers are coming out. And they're coming out and they're not coming out great. And a lot of people are losing their jobs. And so that's another reason why I think they're holding back until there's a little bit more certainty either with the rates or their job. So typically, when the rates come down, they anticipate or they expect that the employers will hold on to their people or maybe not lay off now that affordability is coming back into play. for their business or what have you. So with the drop in rates, they anticipate that to turn and unemployment be in a better position than it is now. Yeah.
Hopefully. With the distressed sellers, have you been seeing a lot of defaults with the bigger payments from your side, or is it not necessarily with your clientele?
Oof. I did have some distressed sellers. Yes, definitely. Yeah. Default has been on an increase, and that's across the board with all the lenders. It's out there. It doesn't really I hear it more because I deal with the lenders and I I pull credit and I see people's financial situations but it doesn't really hit the news. It doesn't hit the media of all these power of sales. But I do, because I'm in the industry and I'm in it every day and it comes across my desk and I hear it, I see it but what I did notice is it doesn't hit the media. To the extent that's what is actually really happening out there. I have conversations with appraisers, with underwriters, and this is the consensus for sure.
I wonder if there's just like so many mortgages that are placed with the big 5 or big 6 banks where the client is just a good client of that bank and they're able to continue that mortgage, and you're not seeing that level or that type of client isn't in distress, but the type of client that comes to a mortgage broker and might have a non-standard form of income or a more complex situation or whatever, then also sees a whole lot more distress. And so you might be in a position to see that distress before it's reported in the broader numbers because there just are so many mortgages placed with the big banks.
Right.
Okay.
Yeah. Well,
I don't know. Maybe it was a stretch.
Yeah, no. That's why I see it. I see it even for the people with the 8 banks as well, because people may have lost their jobs, and they don't report to the bank, but they're having financial difficulty and they can't refinance if you don't have a job. So they're trying to hang on as much as they can, but it's of all classes. Like I know personally a few people that had high paying positions, and they were the ones that got let go of the business, right? For the company, it's the higher paying jobs, so because that's where these companies are going to see the most cost savings. They rather let go somebody of, that they're paying, 5 times the salary of somebody else. They rather let go of one person than 5 lower staff. So I'm seeing a lot of that too.
Yeah, and it's tough to replace that income as well from that higher income. Those jobs just aren't being posted every day either, right? So if you're making an average wage, you can probably find something else comparable out there if you look hard enough and are willing to do some different things. But
right,
yeah, you are right though about the media. I wrote something in one of our newsletters a month or two ago where there was like a page 6 report, and I had to go look for it. On Ontario defaults over 30 plus days. And it reached $1 billion. And it was kind of like this one little headline and gone in the next news cycle. Whereas we're seeing like interest rates, we're talking about that every day. And yes, it's important, but the fact that there's over $1 billion, and this is, a month or two old data, that's got to be important as well, that people are really, really suffering. And when you're hearing, our government's telling us that everything's good and GDP is the best and employment rates are this, and we're seeing at an individual level how difficult it really is for the average Canadian, you are right. That is something that definitely should be talked about a little bit more. So I'm happy you're here to be able to talk about this as well.
The longer they hold the rates, like in my opinion, I feel that they held the rates too high for too long, and they did a lot of damage that's irreversible at this point. And yesterday, the Feds, the US, they dropped it 0.5 point. And now with the latest inflation numbers that came out this week, it dropped lower than expected. I think the consensus was 2.1%, and it came down to 2%. So now our job numbers are really are dropping faster. Our inflation numbers dropping faster. Now there's talk of them dropping the next rate of 50 basis points, which is in October. And to me, when that happens, it's almost like a panic that they made an error. And even though they're dropping it now, I think the damage is done. It's too late for a lot of people. Every time they do a rate drop, it takes over a year and a half for that rate to cycle through the system for people to feel it. So I think now, even though they're dropping it, it should have been done, I think, a ways back.
Tania, you and I have talked about this a few times. We did that podcast in February, I believe, and we were saying it's already too late at that point in time. It took a little bit longer.
Wow.
Yeah. We were talking about it last year as well, just in some of our conversations about how it's time, how the cracks are there. There was an article that I had posted, knowing that I was going to be talking to you, from Yahoo Finance, talking about how the Bank of Canada's Governing Council are growing concerned that high interest rates might bring down inflation by more than necessary. So there is a lot of this, that, like you said, that panic now that, oh my goodness, we waited too long, and it's like, I'm not an expert in this. I'm a financial planner. I don't sit there and look at the interest rate and all the data that they get on a daily basis. But I felt like it was too long, just talking to my clients and understanding what was going on with just regular middle class Canadians, and we're there now where it's too little, too late, and a lot of people are suffering because of it.
Yeah, I think the majority of the mortgages are up for renewal at the fourth quarter of 2025. That's when the bulk of mortgages are up for renewal, and I think there's a race in time to get those rates down before that bulk comes up for renewal. Otherwise, we're going to see some not pretty stats.
Yeah, that's exactly what I've been feeling, because that's when my mortgage actually renews, I think, in early 2026. And I've kind of thought this through because I have a very good rate. I'm very happy with it. I rate locked in the fall of 2020, I guess it was, right? And so where everybody else is renewing in that like end of 2025, I'm going to have to renew into 2026. And I'm really curious to see what's going to happen in that kind of period of time. Because if you have too many mortgages renewing at higher rates, you are going to have an awful lot of strain on the system, right?
Right.
And if you combine that with a failing economy where people don't have the jobs and the income to support the mortgages they have anyways, and then they're getting more expensive as well, you have an awful lot of stress. Which provides opportunity for those people that can take advantage of it, and is a disaster for those people that are on the wrong side of those changes. So obviously there've been a lot of people that have been crimped by increasing rates. Now we're seeing them coming down, and I think I agree with you. I think we need lower rates through that like end of 2025 period, just to make sure the system doesn't break under the amount of debt and the cost of it for the average household.
Well, it's been so tough, Adrian, where, most people have been up against that for so long because how expensive housing prices have been. You haven't had the flexibility to say, okay, I'm going to buy something a little bit cheaper, make sure that I've got a buffer and do all that. If you want to get in the housing market, which, most Canadians, we do, it's a pretty important part of, who we are as a society. It's been so tight, for a very long time. So most people don't have that buffer. So when that goes up by $500, $600, $700 a month, they just can't figure it out. And then on top of that, we've got, car payments that I wrote about this in one of my newsletters. My lease just came up recently, and I went from a 0.99% lease rate to like 7.99%. And so, that's increasing. The cost of food's increasing, and then mortgage rates on top of that. It's scary.
Everything. Yeah.
So Tania, then with rates starting to come down, like in the past, when you've got a cycle where rates are coming down, there are people who will break their mortgages to get into lower rates, and they'll pay a penalty to do that. But when you do the math, in some cases it makes sense to do that. And those penalties can be substantial, but so can the savings.
Right.
Have the rates come down enough for that to start happening? Are you seeing some of that? Are you seeing any of those conversations? And my follow-on question there is, if somebody's being forced into renewing their mortgage now, is there anything they can do to be prepared to potentially take advantage of that if rates continue to drop?
Yeah, so this is the same thing we'll probably see like we did during the pandemic when all the rates were coming down and everybody was breaking their mortgage and refinancing. So I am seeing that inquiries already. And just coincidentally enough, I had a deal closed today for that exact same reason. They were actually with an alternative bank. They qualified for an A lender. I had switched them over and they saved about 2.5%. Now, I did a calculation for them and I did a cost analysis to say, okay, if they stayed with their mortgage to the remaining term, this is what they would pay versus the new rate, and what the penalty would be. And it was advantageous for them to do so. And they did that. But it doesn't work for everybody. So you would have to also investigate what your penalty would be, yes, and what you would pay for the rest of the term compared to what you would get in your new mortgage to see if it's worth it.
So are there particular lenders that tend to have better
rates,
penalty terms or something like that?
There are. There's okay. Right now, there's a big rate war between all the top lenders right now. I don't know if you're aware of that. So they're getting really aggressive because the volumes have been so low that they're getting really aggressive in obtaining new clients, new business. And your question, was the penalties. Yes, the penalty calculation. So I deal with the banks like Scotia, TD, the top 5 banks, and then I deal with like credit unions as well, and mortgage lenders that are governed by the province. They're provincially governed, not federally governed like the banks are. And these mortgage lenders, such as First National is one of them, or they have better RMGs, another. They have better calculations, penalty calculations. CMLS is another penalty calculations versus the big banks. So there is definitely an advantage to going to some of these mortgage lenders. You can only access them through a broker, such as myself. They're not open just to the general public for anybody just to go and direct contact with them. They don't have bricks and mortars either that you can go and open up an account. They're strictly mortgage lenders. So yes, that is actually one of the considerations that I go through with the clients. It's not all about rates. A lot of people don't understand that. They're very rate sensitive. They don't understand that every mortgage product is different. It comes with different features. And sometimes you think you're saving 0.1%, but the penalty calculation is so much different that if you do break your mortgage, they will catch you on the back end. So there's, the stats are 60% or 3 in 5 people will break their mortgage within their term because life happens, right? There's marriage, there's divorce, there's death, there's loss of jobs. There's so many moving, that there's so many situations that can happen that even though we don't anticipate, we don't plan it, it happens. And as a result, people are faced with having to break their mortgage and then facing a big penalty in the end. So that is really, really important to look at is the penalty calculation.
Interesting.
Yeah, that's good to know because I think a lot of people get really, really rate sensitive, and they miss out on how tied in are we on these things. I was having a conversation with one of our other advisors here regarding just a comparison. We're doing a comparison between one of our clients' portfolio and another portfolio, and it was really good rates of return. And I think a lot of people focus on that side, on the investments. And we were kind of talking about some of the downside risks and the protection. And, it's all great when things are going in one direction, but what happens if something else happens? And same with mortgages, where it's really good if you get a better rate and you stay there for the full term. But if life happens or there's an opportunity somewhere, just to have that flexibility to make those changes could save you quite a bit more than even what that rate would be, right?
Yeah, so it's very important for your mortgage broker to go through all the features of a mortgage, not just rate. It's not just rate.
I think people undervalue flexibility in just almost every regard of life. Like
yes.
People think that the current is going to continue, whatever that is.
Right.
And it may, but it may not. And I think people really undervalue how important it is to have flexibility built into everything, right? Everything.
I agree with that 100%.
Now, you were talking about the big banks sharpening their pencils and being more competitive because there just hasn't been enough deal flow. Does that affect your business? Like, are you finding it harder to compete against the big banks like these days, or is there enough enough folks that also that don't qualify to work with the big banks that there's lots of business left over for you? Like, how's the competition?
So, like with regards to the big banks, I mean, I shop it around between, TD or Scotia, let's say, or, there's National Bank as well. And I look at the rates and I see who's offering. But what they're doing is they're not really posting their true rate that they can give you. It's more like submit your deal, we'll review it, see how strong the application is, and then we'll let you know what we can give you, So that's the way that's the way it's going right now. And it never used to operate like that. Maybe one of the big players would do that, but now I feel they're all doing that.
That
or
sounds
most of them are
sneaky.
doing that. Yeah, right. Because they don't want the other lender to know what they're offering, because then they'll just match it, right? So that's what we're seeing. That's what I'm experiencing. And so basically, I mean, the competition, it's just the profile of the client too, because every bank is different when it comes to qualifications. So I'm working on one right now. This morning that came through was for a refinance, and they fit the profile for TD, but not Scotia. And sometimes it works the other way around. So it's basically like where they fit, and everybody's situation is totally different, and all the bank's rules differ in some way or another. So in that sense, maybe there's not that many options, But with regards to rate, it's almost like I keep giving the same analogy to my clients. It's like you go to get gas at Petro-Canada, and then they may be quick to drop the rate, but then within the price per liter, but then and Shell might be a cent or two more, but then within a couple minutes they'll drop it too. So sometimes we'll start off with one bank, even if their rate is a little bit higher, but within a day or two they're going to drop it, because they have to remain competitive for, unless they're pricing themselves out. And we've seen that with one of the big banks last year, where they priced themselves out of the market because they were trying to slow down their business. Now they're back in full force, and now it's just competing. It's really cutthroat with the rates right now. And you see that on the B side too. It's really, you're not going to get one big advantage over another when it comes to whether you're on the A side or the B side. They're very competitive within each segment of the market with each other.
And I just wanted to clarify something, just the way Adrian kind of asked that. I want to make sure that anybody listening to this or watching just understands that you can deal with all the A banks as well as the B banks, as well as private, that you're not just in a certain segment. You've got access to pretty much everything that's out there, right?
Yep. I'm licensed to do private now. They just put this new licensing, it's mandated now for brokers now to be licensed to do privates, which I think is great. I think that's very welcoming for sure. So A banks, alternate banks, privates, yes, I do it all. So everybody's situation is so different. They can fit, and it changes too. It's very fluid, right? It can change. One person could be at a B bank, and now the next year they qualify for the A bank. So I look at their future, what their situation is, and okay, maybe it might be temporary that we have you in a B bank right now, but then it looks like next year we can get you in an A bank. So I look at, and then that based on their situation determine if you're going to take a 1 year, a 2 year, like how long do you think you're going to be in this whatever situation you're in before we can move you. So everybody's situation is so different.
I was going to ask about term, and I guess in the context of rates coming down, because just, as we record this, the Fed's 50 basis point drop was yesterday. And yes, that's the US, but I think that gives Canada cloud cover for further rate reductions as well. So are you finding that people are taking shorter, you mentioned that variables are more attractive. Are that people also taking shorter terms on their fixed rates, hoping that, 2 years from now, they'll be able to refinance into a lower rate?
Right. So right now we're in, the 1 year and 2 year at the A banks are really high. They're in their 6% range.
Wow.
If you're on the A bank, they might take a variable rate, or they'll take a longer rate, because now the 5 year rate right now is maybe mid to high fours. Okay. Let's say, but if you're on the alternate side, they may take a shorter rate. They might take they're also in the high sixes, let's say. Not much difference between an A bank and a B bank with the 1 and 2 years. They're in the 6% range. But they may look to take a lower, like a 1 year term, in hopes of next year, maybe the rates will come back. If they're still planning to be on the B side, at least they're going to renew at a lower rate next year. Whereas if you're on the A side, you might just, be comfortable taking that 3 year or that 5 year in the mid fours and ride with that.
I feel like mid fours is low now after where we've been for the last 2 years. It's funny how that recency bias changes, where 2020, 2021 mid fours would have been just ludicrous.
Yeah, crazy. Yeah, and then at that time you're getting sub 2%. Like you can lock in at 1.5%. I was telling people go 10 years, and some people did.
Yeah,
And
that's my biggest regret on
yeah,
mine is that I only took a 5 year and like
why
7 was an option. Why didn't I do that?
7 yeah.
Yeah. Is there anything we haven't asked you that we should? Like what's going on that we should talk about that, we've picked on rates a bunch, but what else should we be, paying attention to at the moment?
Well, I'm also in the market. Like I'm in the market a lot too. So I see what's happening with the housing. There's a lot of inventory. So it's a really good time right now, actually, to jump into the market because you have, there's room for conditions and then you're not in a bidding war right now. But I feel the longer you wait, the more people are going to jump in, especially once they drop the rates. More and more people are going to jump in. That inventory is going to dry up and you're going to be back in a situation where you may be limited on the conditions that you can put on your purchase. You may be in bidding wars again. So I really think now is a great time if not already, people are going, it's starting.
Yeah. No, that makes a ton of sense. And especially if you're mortgage free or have low mortgages and the rates don't matter quite as much to you, it seems like a really good time to do it. One of the questions I had, and I get this a lot from clients, is they see the interest rate come down from the Bank of Canada, and they right away expect that fixed rate is also coming down. That's not necessarily true, is it?
No, it's not. So I get a lot of calls on that too. Oh, interest rates came down. I said, no, the prime rate came down, right? The overnight lending rate came down. So that affects variable rate holders, not fixed rate holders. Fixed rates are determined on the bond market, and the variable rate is determined on prime. So when the prime rate drops, it's an automatic drop for variable rate holders. But typically the fixed rates will follow. But it's not when they announce, a quarter point drop, the fixed rates didn't drop a quarter point. It's the variable rates that did. Yeah.
Right. Yeah, that makes a lot of sense because get that quite often where I was like, okay, I'm going to get a better. No, that's not necessarily how that works.
Right.
Yeah.
And for clients who are pondering like a move or refinance, like how do you keep an eye on rates effectively? Like you're in it all the time, but
right.
You can't be talking to everybody who's pondering, refinancing all the time. Like you can't be the source of this information. Like how do people keep an eye on rates? When should they be in touch with you?
Well, I guess it's just like the media, when they're saying that the prime rates dropped, everybody thinks it's all rates. So they jump in, but really so it's, I guess it's the media. It's out there. It's, word of mouth. But people call me all the time too. I let them know they want updates. They want to see how much they can qualify for now or what have you. Another thing I wanted to make mention was the people who are jumping in now. So a lot of people are waiting for the rates to actually drop. Right. But I tell some people, I said, well, listen, if you put in an offer now, you're in a better position because you're not facing the competition yet. And if you have a closing date of 2-3 months from now, if the rates drop, I'm still going to get you the lower rate at that time. It's not the rate today that I get your application in. I can always drop it if the rates drop.
So, and if the rates did happen to go up, they would be locked in at the lower rate, right?
Because your application is locked with that rate. Yes. Yeah. So they can actually get into the rate today, push out a closing date, 3 months from now, and then I can still drop the rate to what the rate would be in 3 months if they go down further.
Fantastic.
And what are you seeing coming down for rates? You've got your ear to the ground on this a lot. Are there going to be some more cuts come in, do you think, or are we going to hold steady?
Definitely, yeah. They're talking half a point. I think that may be a little aggressive, maybe. I'm just telling my clients, listen, if they're taking variable, let's be conservative. Let's do a quarter point drop in October. Let's do a quarter point drop in December, But I think right now, yesterday I read the stats, it's 50-50 split between whether it's going to be, a quarter point or half a point drop. But I like to be conservative. I don't like to, get everybody's hopes up. And if it drops half a point, then bonus for them, right? But just so that when they make a decision, they're making it on a conservative basis. Do I think they're going to hold? No, I don't think they're going to hold. I think they are going to continue to drop and well into next year as well, at least the first half of 2025.
Yeah, because like you were saying earlier, I think they held on too long. And now it's a little bit of panic mode to get it right.
Yeah, that's right.
Well, that's all I had for you today. That was amazing. There's lots going on in your world, especially with rate reductions and changing the mortgage rules, and it must be a lot of sleepless nights.
It's a long time coming. It was, 2 years of almost subdued. It was very, not as active as it was during the pandemic when we had ultra low rates. So now I see it coming back, and I see this 2 years of pent up demand all coming up to the forefront. And I think now we're going to be really, really busy to make up for it.
Fantastic. Well, Tania, thank you for joining us and enlightening us a little bit on what's going on in the mortgage world. It's nice that there are changes and that those changes are generally in the positive direction, right? We've got lower rates, we've got more flexibility in qualifying, and I think those are positive. That helps people get into the market or move up. And I mean, housing is just such an important thing, as Trevor mentioned earlier, that this is good news and going in the right direction. It might mean the economy's not, and so there's obviously the other edge of that sword. But thank you so much for sharing all of this detail.
Okay, thank you. Thank you for having me.
Yeah, you're welcome.
Well, Adrian, what did you think about that conversation?
There is so much going on in the world of mortgages in general right now. Rates, obviously, the most topical at the moment, but so much else going on as well, with changes in the qualifications and everything that Tania went over. So I thought it was a great conversation. I like hearing from Tania. I like her a lot. I think she knows a lot and shares a lot, and just really fantastic having a good conversation with her.
Yeah, I always find that our conversations with her are extremely enlightening. I think understand that side of the business to a certain extent. You had your mortgage broker license at one point. A lot of our clients look to us as kind of the first line when they're making some of these decisions. But it's just so valuable having someone like Tania there that we can bounce ideas off of, and then bring her on to share her with all of our clients and friends and family, as well. Because there's just so much, and she's so dialed into it. She brought up a few things that I feel like I'm pretty knowledgeable on some of this, but she brought up a number of things that I just hadn't really known yet. So always enlightening.
Yeah, and you're right. I was briefly licensed as a mortgage agent, and I discovered the hard way that it's not something you should dabble in. There is so much going on in that industry all the time. Yes, it is adjacent to everything that we do because it is a part of the financial industry, but it's a unique beast. Every lender has their own qualifications. Every lender has their preferred piece of business or the business that they won't do. Every client is different and therefore fits a different combination of lenders. And so it's just extremely complex. There's a lot of value in being all the way in. And I know that Tania really is. And so, everybody is way better than Tania than ever would have been with me. It's not even close.
No, absolutely. And I love the fact that she's got access to, the big banks, the B lenders, the private side. So, not only for people that are looking to use her to be able to have access to a number of different things, depending on their situation. I don't think she says no to a lot of people very often. I think she can always find a spot for them.
Yep.
But she also has a unique perspective on what's happening because she gets to see it from a number of different sides, which is, just always so great, as opposed to someone who's just dealing with one institution and kind of just knows that one side of things. So, great conversation. So happy we were able to do that. And I'm sure as things keep progressing here with changes either on the regulation side or on the interest rate side, that we'll have to get her back to kind of hear what's happening next.
Oh yeah, there's no doubt that Tania needs to be a recurring guest for sure, because there's always something to talk about in the world of mortgages.
Wonderful. Well, till next time, Adrian, thank you so much.
Thanks, Trevor. Take care.
All right. Bye-bye.